Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, the recording has started. I have to wait for this point to start the lecture. See that a lot of you not coming to the lecture today. So it's really good to come back to this lecture theatre. At least we got someone at the back and looking after everything about the system here. So hopefully we're not going to have on and off mic and the screen will be working properly. Starting from week 7, we're going to deal with a few other asset classes like fixed income, alternative assets. They probably are not as popular as equity, or you probably won't read anything, news stories about fixed income, no matter they are corporate bonds or government bonds or property markets. The coverage of other assets like fixed income and alternative assets is not as extensive or timely as the stock market, but they contribute. They play an important role in the total portfolio context. So still we're going to follow the method of understanding the role that equity plays in a total portfolio context. For the fixed income securities, we're going to discuss the characteristics of this asset class, and particularly we're going to highlight the quite different contrasting roles of fixed income security in fixed income portfolio and total portfolio context, and what might be the implications for individual investors or institutional investors. So we'll start with the potential roles in total portfolio of fixed income securities. For a balanced portfolio, we usually have the dominant growth assets like equity, property, private equity, and hedge funds, and all these are growth assets. The other important portion of total portfolio will be the fixed income securities. They can be investment-grade corporate bonds, high-yield bonds, and government bonds. They actually will have quite different contribution into total portfolio risk and return. The most important role of fixed income securities is actually in the total portfolio context is the volatility reduction. It diversifies the equity risk, which dominates a balanced portfolio. So in the past several lectures, we mentioned a few times, when we look at the total portfolio variation of a balanced portfolio, for instance, you have 60 to 70% as allocation in growth assets, particularly equities, no matter it's domestic or international, and the other 30 to 40% in fixed income securities. Your total portfolio return variation are going to be driven by the equity market variation, up to over 90%. So we have a total portfolio risk exposure. The most important driver of risk will be the equity market variation. So when we try to shift the asset allocation within the total portfolio from the growth assets to the fixed income securities, we're trying to reduce the total portfolio risk or volatility. Fixed income securities help to diversify the economic risk. They are sort of, all of the assets within Australia are driven by the economic development of the country, but they may react differently to some changes within the economy. For instance, the interest rate changes from the Reserve Bank of Australia. Especially for many typical Australian investors, when they hold the majority of their assets in growth assets like Australian equity and international equity, the inclusion of fixed income security will help to diversify the economic risk. And also for the high credit rating fixed income securities, they might protect you from deflation. If you have been following the press release of ABS, you should know that the latest quarterly CPI in Australia is only a little bit over 1%, which is much lower than the expected inflation or target inflation rate desired by the Reserve Bank. So there's some talk in the market about deflation risk, that the economy is lacking any momentum of consistent growing or the desired economic growth in the next short to medium term. So one, there's a true risk of deflation, and with the equities, the growth assets, they're going to suffer a lot because of the deteriorating economic development. But with the fixed income securities with high credit rating, they're still going to pay the coupon and repay the principal. So to some extent, they can protect investors from deflation risk. And also, of course, in the total portfolio context, the fixed income securities will diversify the risk exposure from equities. For instance, during the very dramatic episode of the global financial crisis, during the height of the crisis, Australian equity dropped over 30% in around 6 months of time. The resource company lost more than 50%, and also about 50%. The real estate investment trust, these are the companies who were heavily leveraged before the global financial crisis, lost more than 50%, even 60, 70% of their market capitalization. So they were really at some real risk of bankruptcy. At that same time, during the height of the global financial crisis, fixed income securities, the value increased by about 6%, 8%, depending on which index you were talking about or which country market you are talking about. So at this kind of very dramatic market slide, you do have certain protection from equities. Although both equities and stocks are, that's a fly, if you think what I'm doing. So they are both driven by the fundamental economic development of the country, but they may react differently. These fixed income securities will provide certain level of protection or diversification benefits of the equity exposures. And particularly for a very special type of institutional investors, the DB funds or insurance funds, they have the primary objective of matching the liabilities. So obviously the asset volatility is one consideration, but the priority of their objective is to match the projected liabilities. Fixed income securities have the characteristics of providing certain cash flow or duration, which means the sensitivity of your portfolio value to interest rate changes. We have discussed the characteristics of the project liabilities in liability-driven investment. So they are like a negative bond for the DB funds. So having fixed income securities managed in a way so that it provides the best match with the project liabilities is actually one important approach for DB fund managers. Probably they won't settle on the perfect match, and also it's probably very hard to have a perfect match all the time. But at least having carefully managed fixed income securities within the total portfolio can help them to achieve certain level of matching, no matter it's cash flow matching or duration matching. With the fixed income portfolios, we're not going to learn about how to generating alpha for fixed income portfolios, but this is kind of like part of the block of knowledge. You can have some basic understanding. For fixed income portfolio managers, they are always advertising that we have this certain investment strategy or investment philosophy, we have this very high-profile fixed income manager. We are able to generate alpha. That's the marketing materials from the funds managers. But for academics, we kind of take on a very neutral stand in this debate. We examine the historical performance of the fixed income managers carefully in the way that we use different sample period. We try to control for survivorship bias. Other biases may enter into the reported performance of fixed income managers. It's controversial that fixed income managers consistently generate alpha because of their skills. Skill is the kind of thing that's very hard and very tricky to isolate in empirical testing. But after all of the deliberate calculation of academics, they find it's very hard to measure the skill of fixed income managers. So some fixed income managers, they do outperform the other peers or a benchmark, for instance, but it's hard to say it's purely generated by their skills. For example, their exceptional, correct or bad insight of the interest rate movement, of their superior selection skills in investing in high-yield bond or distressed debt. Of course, for example, PIMCO, that's the world's probably still the largest, most prominent fixed income manager. They still provide value for investors, especially for investors who have a clearly defined objective or investment horizon or their preference. The fixed income portfolio can be tailor-made for these investors. The fixed income portfolio management, especially when they have the objective to generate positive alpha, they can either fall into a category of investment horizon of betting against the interest rate movement, or they either try to do security selection to identify the undervalued high-yield bond. The bet on the interest rate movement, we understand that for a fixed income portfolio, the interest rate is obviously the most important driver of the portfolio value and also the portfolio return as well. So for instance, if for now we do expect there's a 50% chance of Federal Reserve is going to reduce the target interest rate in the next 12 or 18 months, if you're managing a fixed income portfolio, how are you going to change your asset allocation? I mean, within your fixed income securities, you have different corporate bonds and government bonds of different durations. So if you do foresee a reduction of interest rate, how are you going to change the composition of your fixed income portfolio so that you might take advantage of the market movement and generate a positive alpha? Can you recall anything from your investment course or foundation of finance? If you foresee a reduction of interest rate, what will happen to the value of fixed income securities? Does it go up or go down? Yes. So if you foresee there a reduction of interest rate, it's very likely the price of the fixed income security is going to go up. So now you're holding a fixed income portfolio of the securities got different durations. You want to change the composition of your fixed income securities within your portfolio of different durations. Do you try to increase the duration of your portfolio or reduce the duration of your portfolio? If you expect there will be a price increase, do you increase the sensitivity of your portfolio to interest rate or reduce the sensitivity of your portfolio to interest rate? Sorry, I can't hear anything. Who's talking? Do you want to increase the duration or reduce the duration? Yes, increase the duration, because you foresee a reduction of interest rates, so you expect a capital gain of your portfolio. Then you probably want to increase the duration of your fixed income portfolio to generate additional capital gain from the securities within your portfolio. So that's probably one investment strategy of fixed income managers. They forecast, they try to bet on the movement of interest rate. To generate alpha, they try to change the composition of their portfolio, shifting from the low duration securities to high duration securities. Another investment strategy, a category of strategy, will be these managers, they try to do security selection, especially they probably are specialized in identifying the undervalued distressed debt. So this company might be very close to default. They probably have experienced some external shock, for instance, unexpected technology changes, and they are suffering from a significant reduction of cash flow, profitability, and now it's actually not very popular with investors in the stock market. And they do have some risk of default of their corporate bonds. So some funds managers, fixed income managers, they are particularly good at identifying these stressed companies that are very likely going to be turned around. So they analyze fundamentals of these companies, maybe bottom up or top down. They identify these firms, they very likely going to experience a turnaround and try to hold on to the corporate bonds of these companies. Hopefully, because they are distressed, they are really abandoned by a lot of institutional investors. For a lot of pension funds, they have this requirement for the funds managers. You cannot purchase any high yield bonds or the corporate bonds of certain level of credit risk. So when there's very limited demand in the market, the price of this distressed debt is depressed and they tend to be undervalued. So some fixed income managers might identify this undervalued distressed debt and try to hold on to this debt and sell them when the company turn around. So that's probably some of the investment strategies that fixed income managers might use in practice. They are not very important for our consideration in asset allocation. We just talk about them in general. The overall risk of fixed income securities. So the volatility. So we don't really have a clear context of talking about risk. So here risk means the volatility of fixed income security, just the quantitative measure of standard deviation. So I did the calculation of Australian and world fixed income index using monthly data, and I calculated the standard deviation of the monthly data over a 60-month period, and it's annualized. If you don't understand the implication of this calculation, you probably want to go back to review the first several tutorial exercises. Why we calculate over a rolling window, and why we need to analyze these quantitative risk measures. So here's the data. We have, particularly for the Australian investors, that's probably the dominant security in the fixed income portfolio. We have very high standard deviation of Australian fixed income back in 1980s and early 1990s. This is not difficult to understand because during this time we had double-digit inflation. During the high inflation period, the interest rate movement tends to be more volatile. That's the risk of the fixed income returns. Starting from 1993, that's here, when the current inflation-anchored monetary policy came into effect, gradually, the standard deviation or the risk of Australian fixed income securities came down, especially when the resource boom started at the end of 1990s, early 2000, the standard deviation came down to about 3%. And in recent years, it was even much lower to about between 2.5 to 3%. So that probably, like the standard deviation experience of Australian equity, we experienced a regime change, a shift of the fundamental drivers of the risk of this asset class. So compared with Australian stock, if you can still recall that the long-term average of the standard deviation of Australian equity can be, of course, it's above 10% and might be sometimes up to 15%. Compared with equity, Australian fixed income obviously can provide certain diversification for a portfolio dominated by equity because of its much lower standard deviation and very moderate return. The historical return from Australian fixed income on average in the past 30, 40 years is about 6%. So that's very nice return on such low level of standard deviation. The possible exposures within the fixed income portfolio. So we are talking about the volatility, the the risk of a fixed income portfolio, probably from the perspective of a fixed income manager. We'll come to the discussion of the case of a total portfolio context later. So for fixed income portfolio, I hold a portfolio that includes corporate bonds and government bonds. So the key driver of my portfolio variation will be actually the interest rate. I include slides here to show you the inverse relation between the interest rate and bond price. If you need, you might review this slide at your own time. So you should have learned this from investment or foundational finance in the first 2 years of the finance program. So interest rate is the most important driver of fixed income portfolio risk. And another key driver will be the credit risk. We'll talk about credit risk later. Now we focus on the interest rate risk. How do we measure interest rate risk? Is actually using yield curve. Probably it's not covered by the media or even when you read Australian Financial Review, they don't really talk about the yield curve a lot. But recently, especially if you're following the economic development of the US market, you probably will read a few articles on the yield curve. Because right now we are at a very particular, very interesting state of the economic uncertainties right in front of us, that we have a slightly inverted yield curve. That's the purple curve you see here. Maybe the color is not very clear, so I'll show you that the dotted line here, that's the latest as about 2 weeks ago when I updated the slides. So now we have a slightly inverted yield curve. What's the implication of this yield curve, and how does it affect our investment decision for the portfolio managers of fixed income securities or for ordinary investors who hold a total portfolio? The implications can be quite different. Now we're going to start the discussion by looking at the other yield curves. So yield curve is a graphic indication of the yield, market yield of fixed income securities of different maturities. So on the horizontal axis, we have the maturity of fixed income securities here. That will be the US government treasuries and government bonds. So if we're looking at that's the purple curve, that's the latest yield curve. So on the 12th of April, on that day, 3 month US Treasury has a yield of about 2.5%. 2 years, about 2.4%, 2.3%, and the lowest point was actually the 3-year maturity government bond of a little bit over 2.3%. And with the government bonds of maturity of 10 years, it goes back to about 2.5, 2.6%. For 30 years maturity of government bond, it has a yield of close to 2.9 to 3%. So that's what it tells us by looking at the curve. On that day, that's the yield offered by US government treasuries and bonds of different maturities. What can we expect from this yield curve, the shape of the yield curve? Obviously, the yield curve indicates the expected inflation that will be prevalent in the market 2 years from now, 3 months, 2 years, or 10 years, 30 years from now. That's the market expectation on that particular day. So if it's market expectation, it's not going to be static. It's always changing. Over a short period of time, they can be quite stable. I actually have this yield curve data from the Federal Reserve here. So that's the latest, 25th. That's today of the US. We are a little bit earlier than US. So today, the US yield curve is very similar to the yield curve we have observed on the 12th of April. So over that period of time, especially in April, the yield curve is flat and slightly inverted. So what do we know about this slightly inverted yield curve? The yield you see here indicates the market expectation of interest rate. So it looks like the market is expecting the interest rate in the US is going to be reduced to about 2.2, 2.3% in about 2 to 3 years of time. And currently, it's about 2.5. Let me ask you, when do you think the Federal Reserve is going to reduce the interest rate? When the economy is really expanding relatively positively, there's a rosy color of the economic development, everybody is happy about the labor market performance, everybody is about the expected inflation. Is it very likely the Federal Reserve is going to reduce interest rate? When did the Federal Reserve reduce interest rate, especially during and after the global financial crisis? Recession? Yes, when they foresee a recession is rolling down this way, they're going to reduce the interest rate, try to stimulate the economy. So the market is expecting there will be a recession in about medium term, probably 2 or 3 years of time, and they would expect the Federal Reserve is going to react by reducing the interest rate further down to about 2.3%. That's what we can tell from the observed yield curve. That's the market expectation. What about the long term? 30 years. If you look at the shape of the curve, the market does expect that after the medium term of probably a possible recession, reduction of interest rate, and they expect the Federal Reserve is going to increase the interest rate gradually especially after 5 years. When do you think the Federal Reserve is going to increase the interest rate? When they see the economic development positively or negatively? Positively, yes. So probably from the shape of the first half of the curve and the second half of the curve, we can tell that the market expects we are going to have a recession in the US in medium term, probably 2 to 3 years of time, and then they're going to have a gradual slow recovery out of the recession, and the economy starts to pick up again after 5 years. And that's when the Federal Reserve is going to increase the interest rate. So that's what we can tell from the latest yield curve. Do you agree with me that we're going to have a recession in the US? That's the signal we can pick up from the Treasury market. Do you agree with me? There's a recession? Well, we had a quite long extended break. Are you following the US stock market? What happened in the US stock market? What happened? Do you even listen to the radio about or read anything from even Sydney Morning Herald or Australian Financial Review? What happened to the US stock market? Are you checking it right now? Since Christmas last year, US equity market, even Australian stock market, have such long run increase, almost not 30%, but a quite significant amount of increase since Christmas last year. And it didn't stop until yesterday. So obviously this yield curve has been there for the entire April. Right now it's such an interesting time that we observe conflicting signal from the stock market and the Treasury market. What do you think? If you are managing a fixed income portfolio, is this yield curve more relevant or the performance of the stock market more relevant? Which one is more relevant if you're managing a fixed income portfolio? Which one? Yeah, the yield curve. Why are they providing us such conflicting signal? The yield curve, or the price of US treasuries, US bonds, are obviously determined by price. Who are driving the price of treasuries? Who are driving the price of treasuries? In financial market or any market for any product, what determines the price of an asset? Supply and demand, yes, exactly. So in the US Treasury market, it's supply and demand is driving the price or the observed yield curve you observe here. Who are trading in the US Treasury market? Like us, individuals? No. The fixed income market is the OTC market, and it's traditionally only open for institutional investors. So what we observe, like there's a possibility of recession and recovery in 5 years, is the expectation of institutional investors, probably. But it's not the entire story. Because institutional investors, they trade fixed income securities out of a lot of reasons, not just because they try to make a profit from their holding. A lot of institutional investors, they actually buy and hold the fixed income securities. They don't really trade a lot, unless there's some changes within their total portfolio or there's some substantial changes of their view of the market. So we have this partial signal from the US Treasury market that there might be a recession on its way in about 2 to 3 years of time. Who are trading in the stock market? That's what we try to understand the signal from the stock market. Who are trading in the US stock market? Individual investors, institutional investors like the US pension funds, and a lot of international institutional investors. For instance, for my personal portfolio, of all of my equity exposure, I have 50% of exposure in international stock, which in turn includes 30% of its international index of US equities. So the investors who are trading in the US stock market have much more diverse background, much more diverse range of objectives, and that's probably a signal of the average view of the market itself. So international investors, institutional investors, and also individual investors. But given the last 4 months of consistent upward rising of the stock market, we probably want to just pause a little bit. If you want to buy more US stock, probably it's overvalued. If you go to the library and go to the database of Factiva and do a search using the keyword of US plus equity market or P ratio, something like this, you might get the results of the latest P ratio of the US stock market. The latest, the past several months, the uprun of the US stock market is mainly driven by the better than expected corporate earnings. But given the uncertainty of the presidential election next year, and also the trade conflicts of US and with its major trading partners, there are still substantial uncertainties for the US economy. So we are not sure these companies are going to produce such stellar performance of generating consistent growing earnings or profit in the next several quarters. Now we go back to the Treasury yield, and you see I have a few curves here. And the red curve, that's the internet bubble. The orange curve, probably that's still not very clear color. So that's the orange curve for the global financial crisis, the height of the global financial crisis, before the Federal Reserve and all of the central banks around the world started their quantitative easing yet. And also the green line here indicates the yield curve in 2011, so about 3 years after the global financial crisis. If we compare these yield curves, which one is obvious, we can tell which one is similar to the current yield curve, right? That's the orange curve. Rather flat and slightly inverted. That's very similar to the current yield curve, the shape. So maybe there's a recession coming on its way and a gradual recovery from the recession, as what happened in the during and after the global financial crisis. So that's how we make use of this yield curve in understanding the market signal. Then we still come to this point, how we make this useful in investment decisions. For instance, we have this fixed income portfolio, and having fixed income securities in my portfolio only. How can I make investment decisions to take advantage of this expected interest rate changes? If I'm managing a fixed income portfolio, do I increase the duration or reduce the duration of my portfolio, given the current yield curve? increase the duration of my fixed income portfolio so that I can have better capital gain of my fixed income securities. What about the investors who hold a total portfolio, a balanced portfolio, for instance? I'm 20 years old. There's 40 plus years of investment horizon. I'm holding over 90% of my assets in growth assets like equities, private equities, hedge funds, and properties. I have like probably 5% in fixed income securities. Looking at this yield curve, especially the latest yield curve, that's the US. I'm a US investor. Does it really matter for me if I hold a long-term investment horizon and the money is in my pension fund? Do you want to do anything with your asset allocation? If I have 40 plus years of investment horizon and I do see, okay, maybe there's like probably 50% of chance of recession, a mild recession, because that's only a very slight decrease of interest rate in the next 2 to 3 years. Do I go to my pension fund and change the asset allocation of my portfolio? Probably I just leave it there as it is. But what if I'm a US investor? I'm 65 years old. I decide to retire in 2 years. I hold 70% of my portfolio in equity, 30% of my portfolio in US treasuries. What do you suggest me to do if I'm going to retire in 2 years? Which means that when I retire, the economy is probably in a recession, a mild recession. What happens to my total portfolio if there's a recession in the next 2 years? 70% in equity. What will happen to my portfolio? Anyone is saying anything? Can you please be louder? Yes, there will be might be some loss in my total portfolio because the equity market tends to perform poorly in a recession, given that I have 70% of my portfolio in US equity. So what do you suggest me to do if I'm going to retire? I'm going to take a lump sum from my pension account. What do you suggest me to do in terms of asset allocation? Sorry, can you repeat? Yes, exactly. So if I'm going to retire in 2 years, I'm going to retire in a recession, and I'm going to take a lump sum out of there. Right now, my investment decision is probably to shift some funds in equity to the fixed income. At least when there's like a reduction of interest rate, I'm going to have capital gain from my fixed income securities within my total portfolio and sort of limit the loss of my stocks. So it really depends on the investor's circumstances. The investment horizon here is very important, probably the most important consideration in the asset allocation decision. And also the investor's preference of how they're going to deal with this pension fund. Things can be quite different if you're going to take a lump sum from the pension account or just stay within the fund and stick with that investment portfolio. So if I'm going to retire in 2 years, I don't want to take a lump sum. I want to keep the investment portfolio there, and I have no intention to convert my pension fund into any annuity stream. I'm going to maintain my portfolio invested in stock and fixed income. Probably you still want to shift some funds from stock to fixed income and see how you go with the recovery of the recession. Then you probably want to settle onto an asset allocation at a level of risk which is appropriate for your retirement lifestyle. Okay, that's probably the most important exercise for this lecture. We observe market signal, and we try to understand the implication of this market signal, and we try to make some sense out of this market signal in investment decision in different circumstances. If there's anything that's not clear or you have question about this, come to talk to me after lecture. Okay, now we come to the numbers. We have this fixed income portfolio, still fixed income portfolio, and we use an Australian fixed income index as a proxy of the performance of the fixed income portfolio. So we try to identify the key drivers of my fixed income portfolio return variation. Now I look at the R squared, very simple, straightforward. I look at the R squared. That's changes in Australian government bond yield, especially long-term government bond yields, can explain up to 75% of my fixed income portfolio variations for Australian investors. And you probably can include Australian equity variations or the interaction terms. That increase is very marginal. So for Australian fixed income portfolio, the key driver will be the interest rate that you can observe from the long-term Australian government bond yield. If I hold a geographically diversified international fixed income portfolio, so I have exposure to most of the major economies in the world, including some emerging markets. So now I have a very diversified portfolio of fixed income securities. I still try to identify the major drivers. And actually you'll find up to about 50% of your world fixed income portfolio return variation can be explained by the US interest rate changes, about 50% here. So there are some important omitted variables in your regression. Some other fundamental drivers we cannot capture with the interest rate movement. So that's going to be beyond the discussion of asset allocation course. If you're going to do any course in fixed income portfolio management, you probably will have more discussion on what these variables will be. So at least the key message from this calculation is actually for fixed income securities, interest rate movement is the major driver of fixed income portfolio returns and risk. Okay, we're going to take 5 minutes break. After the break, we're going to talk about something a little bit tricky. That's when we introduce the total portfolio context in our discussion. Are there any questions about the exam on Wednesday? Anything you want to raise? No? Any complaint? The exam too difficult? Too? So that it's recorded. Before the mid-semester exam, I'd ask you to do your own exercises, writing on the questions from your tutorial exercises. How many of you have done that? And I also give you some after-lecture questions to ask you to practice. What do you think the most difficult thing of writing the answers for the questions in the mid-semester exam? The concepts not very clear, or just the amount of the questions? Or you don't really understand the case in the questions? Can anyone give me some feedback? When you say time is not enough, probably you spend a lot of reading the case. You don't really understand what's going on within the case or what you are supposed to write to answer that question. Or it's probably you have too much to write and you don't have enough time. So what's your feedback? Too many questions. 2 hours. Which question did you come to, like question 18? 19. Sorry, I can't hear. Theories. Okay, question 19. Okay. Yeah. So do you find the cases are difficult to understand? Yeah. Okay. Yeah, thanks for that. Anyone came to question 20? No? Sort of, yes, sort of. You have 15 minutes before the exam officially started to read through the questions. So you didn't go to answer question 20 in the first place. Okay. So did you find the calculation difficult? No. I told you a few times, this course is not a calculation course, not mathematical, not really. You probably will find the quantitative part in the assignment is overwhelming if you don't know anything about Excel, but it's actually a very conceptual course. The calculation is very straightforward and quite simple. Any other feedback about the exam? So if you're going to properly rate your own performance in the mid-semester exam, how much do you think you're going to get? Especially for the written part, like 50% or 60% or up to 70%? 60 at most, yeah. That's usually a little bit over the average for the mid-semester exam. Usually the mid-semester exam, the average is about 50, between 50 to 60. Yeah, I know you are used to the written questions in the first 2 years of finance courses and having a formula, plugging in number, punching the calculator, and that's it, you get the mark. Or one is written question, you probably will write a few sentences that you can easily copy from your cheat sheet. But this course I really want to make even the exam an exercise of communication. You probably want to imagine yourself sitting in front of your client, and I'll just ask you, this is my investment horizon, this is my case, and I don't only want to invest in Australian equity and Australian fixed income, and tell me how you're going to model this problem. How do you choose the data, interval and sample period? Explain. I know it's going to be challenging when you're sitting in the classroom and thinking about this situation, but it's actually how you're going to perform as an analyst in finance, not really depend how well you do in exams. No one is going to give you a formula and give you the parameters and ask you to punch the calculator to judge your performance. No. Especially in wealth management, you're put to go to client meetings and do presentation, not just the technical part of punching calculators. It's probably the easiest thing that you can pick up. But actually think about how you make yourself understood in a very effective way. So if you don't do well in the mid-semester exam, it's okay. I really understand the dramatic change that you have to experience from the courses like Foundation of Finance or Corporate Finance in a course like this. Probably in a few years of time, when you think about this exam, it means nothing for your future. When you take a long-term view of your career, this exam is nothing like, but I want you to understand the effectiveness of communication is more important than you get 50% or 60%. I don't really care your grade. I want you to put in a better position when you finish the course to become an analyst. So thank you all for the feedback. I probably will adjust the future exams a little bit to give you more time to think, especially mid-semester exam. The final exam, the cases tend to be more complicated. Yes. So now you have very straightforward layout of the story. So I'm asking you how you're going to model this case. Your selection, consideration of selecting data, and this is my case. My age, my investment horizon, my situation. Please explain the difference of DB and DC funds, the implications for me. But in the final exam, the cases, all of the knowledge of the whole courses are going to be put together. You got to synthesize the knowledge from week 1 to week 12 to provide advice to your client. And also, your time spent on the assignment is not going to be wasted. The final exam, about 20% of the final exam comes from a synthesized case of asset allocation advice. So it's in a context that you can answer in exam environment. Not really, no calculations or modeling will be involved, but the concepts, the understanding of asset allocation considerations are going to be valuable inputs into the final exam written questions. So make sure you spend enough time on the assignment. Do not leave it to the last 2 weeks. You're not going to have this valuable experience of making mistakes and thinking about it and getting feedback from me and correcting anything and improving your assignment in 2 weeks of time. Okay, so let's go back to the lecture of the fixed income securities. Now come to this point, we try to understand how interest rate will be driving my fixed income portfolio risk. Okay, how do I increase the interest rate risk of my portfolio? So we have talked about this. Duration is one particular measure in fixed income portfolio management that it measures the sensitivity of a fixed income portfolio to interest rate movement. So if I look at my fixed income portfolio in isolation, it looks like if I increase the duration of my portfolio, I'm going to increase the risk of my portfolio. So that's the case we can tell from the graph on the left. So on the vertical line, we have the fixed income portfolio volatility. And on the horizontal line, we have the duration or its maturity. It's a proxy, very close to duration. So the longer the duration, the longer the maturity, higher risk of your fixed income portfolio. Especially in short term, that's the data for this period, 1999 to 2008, for Australian government bond index. So when you increase the duration of your portfolio, changing the composition of the securities within your portfolio, you start with 100% in cash and cash instruments, and you replace some of the cash instruments within your portfolio with fixed income securities of longer duration. I can't get my, okay. So when you have longer duration of your fixed income portfolio, you're going to have much higher fixed income portfolio volatility. So what's the key driver of a fixed income portfolio return? The interest rate. So when you actually extend the duration of your fixed income portfolio, you are increasing the duration or sensitivity of your portfolio to interest rate in your portfolio. That's why the standard deviation volatility of the portfolio increases when you increase the duration. Something interesting that you may observe from a total portfolio context. I'm an Australian investor. I hold 70% growth assets and 30% in defensive assets, probably mostly Australian government bonds and world fixed income securities. 70-30 as allocation of a balanced portfolio. Within my total portfolio, we understand one of the key messages that we learn from the modern portfolio theory, the risk should be assessed and discussed at total portfolio level. That for investors who hold a diversified portfolio, the total portfolio risk is the risk that is relevant for the investor. So on the vertical line here, axis, we have the total portfolio volatility. And on the horizontal axis, I have the duration of maturity of the fixed income securities within my total portfolio. So I do not change the asset allocation of 70-30%. I replace some of the cash instruments or fixed income securities of short maturity with fixed income securities of longer maturity within my total portfolio. I still maintain a 70-30% asset allocation. You will see that when you replace some of the short maturity fixed income securities with longer maturity fixed income securities, your total portfolio volatility tends to decrease, at least given this sample period before a little bit after global financial crisis. So that's what Australian investors have experienced. When you extend the interest rate exposure of your total portfolio, increase the duration of your fixed income securities, you actually have such diversification benefits in your total portfolio. Why is this case? Can you guess? In your total portfolio context, when I replace or I can increase the risk of my fixed income securities, I make the fixed income securities more sensitive to interest rate movement. I actually benefit at total portfolio level for Australian investors. Can you guess why? Any guess? Yes. I can't really hear clearly. Can you slow down? Yes, excellent. There's negative correlation between Australian equity and bond returns in the past about 10 to 15 years. That's why when you introduce more interest rate risk into your total portfolio and you benefit more in the diversification benefits of having the fixed income securities in your total portfolio. You have the data from this week's tutorial of all of the bond returns and equity returns. Have a look at the correlation of Australian equity, Australian bond. The correlation is not stable, which is slightly negative in the past 10 to 15 years. If you extend your sample period back to 1980s, very long term, you're going to find the correlation is very close to zero, but it's slightly positive. So it really depends on your sample period to generate such diversification benefits. But what if in the future, next 10 or 20 years, I'd expect the correlation between Australian equity and Australian bond returns is very close to zero. What will happen to my total portfolio volatility if I increase the fixed income duration? Does it increase like this? Does it increase like this? No. When the correlation is expected to be very close to zero, you still have the benefits of diversification. Even if the correlation might be 0.3, it's moderate, and the curve, this line, the total portfolio volatility is not going to increase dramatically like this by several times. It might be flat, or it might increase very, very moderately because the correlation is very close to zero or slightly positive. So investors are going to still benefit from the diversification of including fixed income securities. What's the key driver of a balanced portfolio return variation? We have come to this point several times. What's the key driver of a balanced portfolio return? For Australian investors, what's the key driver? What's the key driver? That's I showed you the bar chart of 93%. What's that? What's the key driver of a balanced portfolio return variation? Australian equity. So when you look at your total portfolio, diversified portfolio of 70% in equity, 30% in fixed income, the key driver is still be the Australian equity market. So when you introduce more interest rate risk by increasing the duration of the fixed income securities within your portfolio, you are diversifying the equity risk within your portfolio. That's where you generate the diversification benefits from having a higher duration or maturity fixed income securities into your total portfolio. The case for the DB funds is quite different. The primary objective for the DB funds is to match the projected liabilities. So if they have duration increase with their projected liabilities, so the parameters, for instance, the age, lifespan of the members, the salary growth in the future, all of the parameters will help the duration of the projected liabilities increase in the future. For DB fund managers, they have to increase the duration of their assets or fixed income portfolio so that they keep up with the changes of the projected liabilities. So increasing duration of fixed income securities within a total portfolio not necessarily increase the total portfolio risk for a typical Australian investor and also for the defunct benefits funds as well. That's the case for the US stock return and US bond return. The graph, the axes can be quite confusing, and they are inverted because it indicates actually the changes in the stock return and bond yield. Bond yield is different from bond returns. This standard deviation of these returns are calculated from returns. So at the first day of the month, I buy the fixed income index and sell it at the end of the month, and buy it again on the first day of May and sell it on the last day of May. So that's how you calculate return. this graph here shows the correlation of stock returns and bond yield. There's an inverse relation between bond yield or interest rate and price, and so return as well. So what we have here, that's negative correlation between equity returns and bond returns. That's what we are interested, especially in the past 10 or 15 years. The correlation of US equities and US bonds returns are negative. You're going to calculate this in your tutorial exercise. See how negative is that number, and you're going to have some real sense how US investors may benefit from these diversification benefits. The correlation on average, if you extend the calculation to the entire sample period in your tutorial exercise, you'll find a slightly positive correlation between Australian bond returns and Australian equity returns. But in the past 10 to 15 years, it's slightly negative. Considering we are making asset allocation right now, and it really depends on your expectation. Is this negative correlation going to persist for how long? And we do observe in the past, they were like from end of 1960s to the early 2000s, about 30, 40 years of positive correlation between US bonds returns and US equity returns. And sometimes they can be quite positive, close to 0.5. So that's quite substantial positive correlation. So when both are correlated at this level, there might be very limited diversification benefits from having fixed income securities, or you don't really have much hedging effects from having fixed income securities in your portfolio to hedge against the equity risk in your total portfolio. So it depends on how you're going to forecast this correlation is going to persist in the future, or is there going to be a dramatic increase to 0, or is going to maintain at this level? Another important driver of fixed income portfolio return and risk is credit risk. So obviously we understand to hold on to a bond, a fixed income securities, you do expect to receive the coupon payment periodically, and at last you're going to get the repayment of principal. Credit risk is the possibility that the coupon or the principal, or both the coupon and principal, are not going to be paid to the bondholders. So that's the credit risk, or sometimes we say credit market, when you invest in the securities that may carry this kind of risk. In characterizing the credit risk, it's usually in a way that we compare the yield of risky fixed income security to the yield of a security of the minimum credit risk, for instance, US Treasury. Depending on your circumstances, the modeling use of your project, you may choose short-term Treasury or long-term government bond. Especially, for example, if you are doing the valuation of a project which has a life of more than 10 years or maybe indefinitely, and you have to choose a long-term government bond as the risk-free rate. So we're going to compare the corporate bond yield relative to the so-called risk-free Treasury yield to measure the credit risk. That's what you observe. The difference between this red line here and this horizontal line here. So when we compare a bond particularly it might be a corporate bond, its yield over a similar duration treasury bond, we'll see this difference. That's the additional return investors require for bearing the risk investing in this corporate bond. If we decompose this credit spread, that's the difference between we decompose the difference between the corporate yield and the treasury yield of similar duration. We actually have this section. That's the credit, the expected loss from a default. That's the key component. For investment grade, this spread is quite small, although on the graph it looks quite big. Just to make it clear to see, the yield spread can be decomposed into several components. Actually, if you go to read from the market yield of AAA corporate bonds with the yield spread of AAA corporate bond over the treasury bond yield of similar duration, the difference is very small, less than 1%. Of course, in extreme situations, for instance, the onset of the global financial crisis, even for the investment grade bond, they had a yield spread of 5%. That was driven by the credit crunch within the capital market. It gradually came down after the stimulus package, more money pumped into the economy. It's actually the credit risk is a particular risk for the high yield bond. That's the division for the investment grade and speculative grade or high yield bond. So if a corporate bond is rated as Baa, that's very close to speculative grade, and if it's rated as high yield, you're going to see a very large difference. On average, this difference with a treasury bond of similar duration can be 2, 3, 4%, even much higher, depending on the situation of the corporate bonds. So the key component, the most important component of the credit risk actually resides on the high yield bond, or the corporate bonds rated very close to the speculative grades. That's the our understanding of the credit risk. Of course, the other risks that bond investors require for compensation are illiquidity risk or other risk. For instance, a lot of corporate bonds are issued with embedded options. That means that the corporation with call option, the corporation has the right to call their bonds earlier than the maturity. For instance, if the market, the interest rate is decreasing, the corporation can recall the previously issued corporate bonds and repay the money to investors, and instead they can issue new corporate bonds at much lower interest rate. So the call and put options of bonds are very popular. About 30% of all of the newly issued corporate bonds have embedded options. It gives corporations the flexibility in their capital management and take advantage the interest rate movement in the market as well. Credit risk is a beta exposure, especially for high yield bonds. This concept is intuitively can be understood in a way that, okay, if the economy is developing as expected, and all of the corporations are spending money, making investment, and paying out dividends, there's less chance of default. They're more likely to pay the coupon and repay the principal at maturity. So the economic risk and corporate probability link will actually determine the company's beta exposure is closely related to credit risk. If there's a high risk of default, if the companies experience some industry level shock, if they lag behind of the significant technological development in the industry, and they probably will suffer from losing customers, and they are going to have negative profit. They might have difficulty paying the coupon or repay the principal at maturity. And at the same time, their stock is going to experiencing negative returns, significant negative returns. So the beta of these companies are going to go hand in hand with the credit risk to some extent, especially for firms that are rated very close to speculative grade, or they are rated as speculative grade. Another way to understand the credit risk or default risk of corporations is the structural view. So, that's actually the underlying theoretical framework of the credit rating agencies of issuing different credit ratings for corporations. So this structural framework is like the shareholders issue a put option to the debt holders, and the debt holders actually issue a put option to the shareholders when they agree to buy the corporate bonds. So the shareholders hold this put option, which gives them the right in the future to sell the assets of the company to the bondholders at the face value of the debt. So it's described in this graph in a way that's the current time right now, and we have an investment horizon of maturity of the corporate debt of H. That's the maturity of the corporate bonds, and that's the value of the assets of the company. And this level, the horizontal line here indicates the face value of the liability, the face value of the corporate bonds. So the company is supposed to repay this face value of corporate bonds at maturity sometime in the future, H. The value of the company's assets will experience these changes of in such a way that it can be represented as a probability distribution when the corporate bond matures. And this probability distribution has a positive expected value, which is slightly higher than the current asset value. So for investors, for stockholders, they do expect the value of the shares will increase by this wedge here. So in the future, they have expected value at this level. And this distribution here indicates the asset value at the corporate bond maturity. There's a possibility that the asset value of the company turns out to be below the face value of the liability of the corporate bonds. So if that happens, if the asset value falls below this face value of corporate bonds, the company is in default. And that's the shaded area means the probability of default in the probability distribution. That's probability of default. This area here, when the asset value turns out to be not as high as the expected asset value, and it's below the expected value, that means the company is distressed. So it's very close to the default. And it's after repaying the face value of the corporate bonds might be left with very small amount of money to continue its operation. So that's the company will be in distress if its asset value is below its expected value. If this happens, when the default happens, the asset value falls below, probably it's right here, falls below the face value of the corporate bonds. The shareholders of the company, they hold the put option. They're going to exercise the put option and sell the assets of the company to the bondholders at the exercise price or the face value of the corporate bond. And they're going to walk away without bearing any other further compensation for the bondholders. The bondholders have to bear the loss of default. So obviously, if this line indicates the face value, the principal expected at maturity, they expect to receive of this level. But if the asset value falls down here, they have to suffer the loss of this difference. So that's the structural framework to understand the credit risk or default, expected loss from default. The credit spreads are correlated with the equity returns, no matter by the intuitive understanding of how the economic development, economic condition, and corporate profitability are going to develop in a cyclical manner, and also in the structural view, the stock returns and credit risk are going to be correlated. When the beta, stock risk increases, and also you will find the credit rating of the company's corporate bonds are going to deteriorate as well. So if we look at the corporate bonds of AAA grade, that's the highest credit rating or minimum credit risk. These companies typically have a beta of 0.05, very small beta. If the companies are rated as speculative grade, for example, B, and they have a much larger beta, equity beta of close to 0.5. So it's another evidence to show that credit risk is highly correlated with stock risk or beta risk. Okay, now we come to our asset allocation problem. That's probably where we have to end up with. So for a fixed income portfolio, I'm only managing a portfolio of fixed income securities. I can invest in this investment grade corporate bonds, speculative corporate bonds, and government bonds. Usually in most of the developed countries, government bonds, especially federal government bonds, are investment grade. So I have the choices of these securities. How can I improve my performance? How can I characterize the my fixed income portfolio risk when I introduce credit risk? So on the left, I have the graph of vertical line as my fixed income portfolio volatility. On the horizontal line, I have the percentage of high yield bond in my fixed income portfolio. I start with zero exposure to credit risk. So 100% of my fixed income portfolio is invested in investment grade corporate bonds or investment grade government bond. I start with a fixed income portfolio without any credit, substantial credit risk. So to introduce more credit risk into my fixed income portfolio, I replace some of the investment grade fixed income securities with speculative corporate bonds or high yield bonds. distressed bonds. They are the different names. So when I increase the proportion of credit risk in my fixed income portfolio, and then I got to have a look at my fixed income portfolio volatility, to some extent, I actually find that up to 30 to 40% of credit exposure, I potentially have diversification benefits. Having more credit risk in my fixed income portfolio, I may reduce my fixed income portfolio volatility. Why is that the case? So when I have 100% investment grade fixed income securities, what's the key driver of my portfolio return and risk? If you have forgotten, let's go back to this. What's the key driver of my fixed income portfolio risk and return? What's the key driver? Interest rate risk. So when I'm managing a fixed income portfolio, 100% in investment grade bonds for Australian investors, up to 75% of the fixed income portfolio return variation can be explained by interest rate movement of Australian government bond. When I have introduced speculative corporate bonds, although Australian corporate bonds market is very small, I can still manage to buy some distressed Australian company corporate bonds. I actually introduce what kind of risk? Is it going to be interest rate risk? Sorry? Can't really hear. That's really not very clear. When I introduce credit risk, what's the driver of the credit risk? Yes, and what's the driver, what's the factor that's highly correlated with the default risk? What I'm introducing into my fixed income portfolio is credit risk, and also what's risk? Is beta risk. So when I replace some of the investment grade bonds in my portfolio with the high yield bond, I introduce beta exposure. So the returns from the high yield bonds, they are very closely related to the stock returns of these companies. So I introduce another source of risk into my fixed income portfolio. That's why I have these diversification benefits in my fixed income portfolio. However, after 30 or 40%, especially after 50%, when I replace about half of my investment, the investment grade bonds with high yield bonds, I found that the more high yield bonds I include in my fixed income portfolio, it's going to increase my portfolio volatility. Why is that the case? Now I have 50% of investment grade bonds, 50% of credit high yield bonds. And when I introduce more high yield bonds, I found that my portfolio's volatility is going to increase. I do not have any more diversification benefits anymore. So up to this point, like 70 or 80% of high yield bonds in my fixed income portfolio, which risk factor is dominating my fixed income portfolio risk? Which risk? Interest rate risk or beta risk? When I have 70 or 80% of high yield bond in my fixed income portfolio, it's the credit risk is going to dominate my fixed income portfolio. And that's why you observe after 40% when you introduce more credit is going to take over the influence of interest rate risk in the fixed income portfolio. Diversification benefits is gone. So for fixed income managers, if the mandate allows them to invest in speculative grade corporate bonds, it actually provides such diversification benefits and might potentially help them to generate alpha. Now we move on to an investor such as the mom and dad investors who actually assess the risk at total portfolio level. For instance, I hold a diversified portfolio of 90% in growth assets, over 90% in growth assets, about 3 to 5% in defensive assets. That's my asset allocation. Okay, what if I include more credit risk in my total portfolio? So I have 95% in Australian equity, world equity, 5% in Australian and world fixed income. I want to introduce more credit risk into my total portfolio. Okay, I'm going to follow the fixed income managers. I'm going to invest in the speculative corporate bonds. What's the impact on my total portfolio risk? Can you guess? Is it going to increase, decrease, or some U-shaped curve? I have 95% as allocation in equity, and what's the key driver of my total portfolio return variation? Equity market return, or beta exposure, stock market exposure. So when I invest in speculative corporate bonds, do I introduce another source of risk or similar, same source of risk into my total portfolio? Do I have diversification benefits? No. So when I have a total portfolio dominated with equity market return variations, when I introduce credit risk by replacing some of the investment grade bonds within my portfolio with high yield bonds, I actually increase my total portfolio risk, because my existing total portfolio risk is mainly driven by equity market variations or beta exposure. By introducing credit risk or investing in high yield bond, I introduce more beta exposure. So that's why we see the total portfolio risk will increase. Depending on the sample period, the level of that total portfolio standard deviation can be different. But this increasing signal, the result is not going to be changed by using different sample period. Okay, good. We still have time to talk about the implications for investors. So for the access to, for Australian investors, if you hold, most Australian investors will actually hold a total portfolio with diversified exposure to different asset classes, something like this. And that's usually the case, that you do not actually manage your fixed income securities. Fixed income securities is exclusive for institutional investors. If you have $5,000, you can go to the stock market, buy some shares of BHP, buy some shares of Qantas or Woolies as you wish. But you don't go to the bond market holding $5,000 of cash, try to buy like a portion of CBA bond. No, that's not going to happen. So usually investors have access to fixed income securities through specialized fixed income managers. So I put my funds with others investing in the fixed income securities. So these managers, fixed income managers, they look at the portfolio risk and performance in a way like this. all in a way like this, in terms of their assessment of interest rate risk and credit risk. But it's going to be quite different for investors who hold a diversified portfolio. That's why for investors, especially investors who hold a diversified portfolio, it's mandatory to understand your fixed income exposure and the way that fixed income manager manages the fixed income portfolio. The risk, the credit risk, can be considered as the diversification benefits for the fixed income manager, but it's going to increase the total portfolio risk for an individual investor. The accessing the fixed income markets, so obviously we are not able to subscribe or buy one corporate bond of CBA or one government bond that mature at a certain date, and it's through specialized fixed income managers or platform. There are different products in fixed income market. They are labeled as cash or enhanced cash, which offers a little bit higher expected return than cash instruments. Cash instruments might mature overnight in a few days or over a week. So they carries minimum level of credit risk. Of course, the return from the cash instruments is very low. It's very close to zero. And passive, so-called passive. The fixed income security index is not constructed in a way as the stock index. When I buy Australian ASX 100, I understand I hold some investment in every single stock in the ASX 100 index. That's not the case as fixed income index. Fixed income index is constructed in a way by sampling and filtering. On Watto, I give you this Bloomberg Barclays a global aggregate index, this global bond index fact sheet. So in the second page, you will find rules for inclusion. So how this Bloomberg Barclay aggregate index is a very popular benchmark used in practice as general bond market performance. But if you go to have a look at how they selected the fixed income securities, you will find, okay, floating bonds, no. And bonds denominated in currencies other than listed, no. And if a lot of corporate bonds are issued as a hybrid security, as convertible, come with warrants, rights, no. And if the bond is going to mature within 1 year, no. So with this long list of inclusion and exclusion, what you are investing, for instance, you invested in the Barclay Global Aggregate Index, you are actually investing in selected issues of bonds around the world. So this passive should be in quotation mark. There's no such passive index of fixed income as the passive index as the stock market. And other ways of how they characterize the products in the fixed income market can be a core portfolio or the satellite portfolio. So with the core portfolio, you probably have domestic bonds only. And with the satellite portfolio, you may have exposure of other country fixed income securities. And if your core portfolio is investment grade only, you may have satellite portfolio of speculative corporate bonds, or sometimes they might include currency bet into the portfolio structure. These structured fixed income portfolios, they are tailor-made to suit the specific needs of some investors. For instance, DB funds, or some individual investors who have particular need of interest rate exposure, duration, maturity, or cash flow. The fixed income index is sort of, for investors, they can be underestimating the risk exposure for investors in a way that, for example, for DB funds, the duration of the projected liabilities is 5 years. Okay, I go to the market and try to find a so-called passive bond index to match the duration of my projected liabilities. You probably will end up with nothing, because the projected liability of the DB funds can be changing all the time, and it may not exactly the same as the duration of the passive bond index provided in the market. And also the duration of the passive bond index in the market is changing as well. So for a lot of DB funds, investing in the cheapest option of so-called passive bond index is not appropriate to serve their primary objective of matching the projected liabilities. And also the risk of these fixed income portfolios or fixed income index is not properly accounted for at total portfolio value, total portfolio level as well. So that the credit risk is very important, probably the most obvious example. For fixed income managers, they consider the credit risk as a diversification benefits or source of generating alpha. But for total portfolio investors, it actually tends to increase the total portfolio risk. So the risk contribution from the fixed income securities within the total portfolio can be underestimated or not measured properly by investors. Another important issue is the shortcomings of fixed income index because of the way it's constructed by sampling and also its long list of inclusion or exclusion. And also, whenever a bond matures, or close to 1 year of maturity, is going to be excluded. And it's very often that companies are going to issue new bonds, and they issue one bond, they have one issue of bond of different tranches. Different tranches may carry with different coupon rate, different options, different protection of the credit risk for the bondholders. So selecting the bonds into the index is a treacherous work. And the index, it changes all the time, every day. So it's not like the ASX 100. When there's like a inclusion or exclusion of a single stock, it doesn't happen every day. You probably will have this market announcement from the companies and from the stock exchange as well. But with fixed income security index, it's always changing because of the new issues, matured issues, or sometimes default issues, or because of the convertible, the fixed coupon period is over and it's going to be excluded from the index when it becomes floating coupon. That actually gives investors a very difficult time of understanding the exact exposure of the fixed income portfolio within their total portfolio. Not just the exposure, and also it's difficult to understand the potential contribution in terms of risk from the fixed income index. They are not easily replicable, and they are issuer driven. So after global financial crisis, when the financial market was flooded with cheap money and the interest rate was down to historical levels, a lot of corporations renewed their corporate bonds, or they can repay their existing corporate bonds earlier so that they can issue new corporate bonds at much lower interest rate. So the corporate bonds market is very much issuer driven. And even with the government bonds market, it's issuer driven by the deficit surplus of the government or the central bank's open market option, for instance, for the Federal Reserve, issuing or recalling some of the corporate bonds, the government bonds is one of the major tools they use to manage the interest rate in the market. And we usually do not have direct access to fixed income securities or index. Even with millions of dollars, it's very rare for investors to construct their own fixed income securities because it's OTC market. And when you have this buy order, for instance, $20 million of CBA corporate bonds of 5 years maturity, you